My name is Dr.K.Karpagambigai, Assistant Professor, Department of Business Administration, Dr. S.N.S. College of Arts and Science, Coimbatore. Now we are going to see about active investment management versus passive investment management. So the active investment is nothing but outperform the market by frequent trading and selecting high performance assets. Here requires deep research and market analysis managed by professional fund managers. For example, hedge funds, actively managed mutual funds. Pros: potential for higher returns, flexibility. The next disadvantage is higher fees, increased risk. Next, passive management. Here, the goal is match the performance of market indexes. Example, S&P 500. Features: uses index funds or ETFs to mirror market performance, low cost and less frequent trading. Example, Vanguard S&P 500 ETF. Pros: low fees, predictable performance, but the limitations is limited ability to perform the market. Next, fundamental versus technical analysis. Here, examine the instinct value of assets, focus on financial statements, that is revenue, profit, debt. Industry trends, market share, competitive positioning. Economic indicators, inflation, GDP growth. Example, valuing a stock based on its profit earning ratio. Technical analysis is studies historical price trends and patterns. Focuses on price movement and volume, tools, moving averages, RSI, Bollinger Bands. Example, using candlestick charts to predict future price actions. Stocks and bonds. Here, stocks is nothing but equities. These real owners of the company. Here, the ownership in a company represent the equity shareholders. Potential for high returns through price appreciation and dividends. Example, investing in Apple at Tilsha. Bonds is nothing but a fixed income. Loans to governments or corporations with fixed returns. Lower risk compared to stocks. For example, US Treasury bonds, corporate bonds. Mutual funds and ETFs. Mutual funds is nothing but a professionally managed portfolio pooling resources from multiple investors. Active or passive strategies. That is, advantages is diversification, accessibility according to a convenience. But the disadvantages is higher fees, limited control for investor. Next, ETFs is nothing but a exchange traded funds. Trade like stocks but track specific indices, sectors or commodities. Typically passive management. Pros, that is advantages is lower fees, liquidity. Disadvantages is prone to market volatility. Summary of key strategies and tools. Here, active management can offer high returns but come with higher risk and cost, because everyone have to concentrate on all the risks pertaining to the investment management. When we take example of equity shareholders, the owner of the company, here the person going to take a high risk and as well as the earn high return. When we go for a preference shareholders, they are not taking any risk. They just need only fixed dividend. Here, the strategies and tools for investment is passive strategies are cost effective for long-term investors. Fundamental analysis evaluates value. Technical analysis predicts trends. Stocks, bonds, mutual fund and ETC are versatile tools for portfolio buildings. Here, the importance is BIS facilitates international trade by aligning Indian standards with global benchmarks like ISO standards. This allows Indian products to be acceptable in foreign markets. Here, The summary is going for a investment management is nothing but a improved performance by the people while organizing the sectors. Thank you.